I like gold. I'm bullish on gold. When you look at central banks around the world, they don't necessarily want to have all their reserves in the U.S. Um, I mean, also when you think of a sovereign reserve, there's kind of two parts of it. One hand, no country ever wants to ever draw down its reserves to zero, right? That'd be obviously a very bad. Something terrible has happened if that has happened.
Lynn Alden expresses a bullish outlook on gold as a crucial asset in a diversified portfolio. She highlights the evolving strategies of central banks, emphasizing the shift away from holding all reserves in the U.S. dollar. Alden sees gold as a robust insurance against potential financial catastrophes, offering stability even in a digital and Bitcoin-driven future. With concerns about the U.S. dollar's long-term fiscal challenges, she anticipates a growing interest in alternative assets, with gold standing out as a strong monetary network. Additionally, Alden shares her optimism about the long-term prospects of energy, including oil, acknowledging the challenges faced by gold miners in managing rising expenses. She suggests considering gold royalty streaming companies as an attractive investment option due to their potential for capturing upside while mitigating energy-related costs. Alden concludes by acknowledging different risk preferences, advocating for broader diversification, larger companies, and streamers for those seeking exposure in the gold market. With that, let's dive into her thesis. Also, make sure to hit the like button, subscribe, and drop your comments below.
So there's basically like their savings account, which they don't need to be as super liquid, but they want it to be secure. And then there's the part that they want to be able to buy and sell very quickly, right? They might want to defend their currency. They might want to pay for oil, and so the for a long time, a lot of countries would hold all of that in dollars or a big chunk of that in dollars. And I think now a lot of them are saying, okay, we can hold some dollars for a quick, transaction we want to do, but for the bulk of it, maybe we want to put that in gold, or maybe we want to diversify that into a couple of different currencies. Maybe we want to make deals with Brazil to basically have a iron exposure for the next 10 years. Maybe we want to do kind of these private equity things. These are these less liquid things. And so I think we're seeing more diversification, and gold plays an important role there. Gold has often played the role of a insurance against kind of financial catastrophe. Going forward, even if we enter a Bitcoin world and digital world, there's never a guarantee that you're always going to have access to the internet. Your private keys can be stored offline, but your ability to interact and receive, send payments and kind of make verified transactions and things that could be limited. And so I think gold still serves a role for what if the internet gets disrupted? What if there's a cyber attack? What if the power goes out? What if this happens? What if kind of true mayhem happens, right? So I think that gold still has a role as a reserve asset, both at the sovereign level and the household level. It just doesn't really solve things at the transactional level. So I'm bullish long term. I think that basically as the dollar over the long term enters more of a fiscal spiral type of scenario, we have very large sovereign debts. If you have inflation and from those fiscal deficits, interest rates become a very mixed tool for fighting that, because interest rates blow out the deficit even more at these levels. It's not the Volcker era where you had 30% debt to GDP. And so the challenge is that I think a number of entities are going to seek alternative monies. And Bitcoin's still too small to really kind of serve at the sovereign reserve level, especially for large countries. Maybe it has to go through a couple more liquidity cycles, get tested a little bit more to see how it's doing. So, gold kind of still stands there as one of the strongest monetary networks in the world. So with miners, one of the biggest expenses is energy in its various forms. And so I'm bullish on gold, but I'm equally, or maybe perhaps more, but also bullish on energy, including oil, diesel, things like that long term. And the problem there is that you can have a mine where your revenue is going up because the gold price is going up, but also your expenses are going up. All your diesel costs are going up. Even things like tires, they're made out of, all that equipment is going through tires on a regular basis. That's all made of hydrocarbons. And just all of that energy intensive work, the manufacturing of the machines, the diesel powered machines. And the problem is that if that's going up as quickly, your margins might still be squeezed. Gold royalty and streaming company gets almost all that upside, but doesn't really have to worry too much about that energy kind of cost, of course, but you're paying a higher valuation for that exposure. So I'd say that if someone is a lot more bullish on gold than oil, then the miners are probably quite interesting for them, because basically they're assuming that their analysis suggests that the revenue is probably going to go up more quickly than their costs. If someone is bullish on both gold and energy, they might then look into the streamers because they say, well, I want to arbitrage the fact that both are going up and I want my expenses to be fixed. In addition, just streamers tend to be more diversified, a little bit lower risk. As a investment analyst in the macro sense, I don't really have time to kind of look through the geology of different companies. I'm not Rick Rule. I'm not going to go out there and identify these like really kind of complex situations. And so for me, I either stick to broad diversification, larger companies, streamers, things like that, to the extent that I want exposure other than just the physical gold. Whereas someone who's more hands-on, they want to take all the risk and reward, can go into the more exploration type of areas or small caps and things like that.
In this next segment, Lyn Alden delves into the dynamics of Bitcoin's major bull runs, emphasizing the significance of both the halving events and positive liquidity conditions. She notes that historically, Bitcoin experiences its most explosive moments when its supply is contracting, halving, while the broader monetary network's liquidity is improving. Alden explains that the ideal scenario is when both factors align, leading to improved supply-demand dynamics and heightened liquidity. She cautions against solely focusing on one metric over the other, highlighting the potential risk of missing out on favorable market conditions. Alden advises a nuanced approach to risk management, suggesting that investors consider accumulating Bitcoin during periods of low liquidity and favorable pricing while reassessing exposure during post-halving bull runs. Overall, her perspective emphasizes a balanced strategy that considers both halving events and liquidity conditions in navigating the Bitcoin market.
I think so. So far, all of Bitcoin's major bull runs have occurred after halving and with positive liquidity conditions. We never really had one where just one was present, and that's often because liquidity cycles historically are about 3 years, and the halvings every 4 years, and so generally you get an overlap there, and so that's why the halving doesn't really, Bitcoin's bull run can happen right after halving. It can take a while after halving because historically it's been both happen together is when Bitcoin has its big moments. We can kind of think of it as like two monies competing. So the smaller money Bitcoin gets harder every 4 years. Basically, the new supply goes down. The bigger money is always expanding, but at different rates. And for a very brief period of time, it can actually contract. And so when the bigger money is contracting, it's basically getting harder, for at least briefly. And so, Bitcoin's going to have its most explosive moments when both it's hardening and the bigger money is softening. Liquidity is improving. That's going to give you the most Bitcoin price action. If they're opposing each other, which so far has not really happened yet, but if it should happen, you probably would expect a more intermediate outcome, where Bitcoin's, the supply demand situations improve, but the liquidity of the other one is still also tight. And of course, the worst scenario is when Bitcoin's, not anywhere near halving and liquidity is worsening from the bigger network. Basically, the more of a mismatch there is, the more demand wants to flow out of the, expanding money into the scarce money. And whenever that takes a step back, demand dries up and there's really no catalyst. So I think that ideally you want to see both occur together. And I think eventually we'll see both occur together. Liquidity could happen right after the halving. It could take another year after the halving. It could take 6 months. I don't have a crystal ball on timing, but I do think that both are very important metrics. I think if someone's too focused on one or the other, they can miss out. If they say, I don't want to buy Bitcoin until liquidity is better, well, you might miss out on some of the cheaper exposures. On the other hand, if you only look at the halving and think you have to have a bull market after the halving, but liquidity from the dollar system is terrible in that time, you might get disappointed that it doesn't work on the time or the magnitude that you expect. So I think that both are helpful, and I don't really recommend trading Bitcoin too much, but I think it's more along the line of risk management, right? So if liquidity is low, if the halving's coming up, that's and the price is low, that's probably a good time to start accumulating a longer term position. And if euphoria is high, if the price is high, you just had a post-halving bull run, liquidity is like soaring and it's starting to roll over. It's not necessarily saying you might want to time the top, but you might want to just make sure how exposed are you to Bitcoin relative to your net worth. Would you feel comfortable with a 70% drop or more? And if not, maybe rebalance, right? Or maybe hedge, maybe whatever makes sense for your situation. So it's more about risk management and expectation setting than trying to trade it.
Today, Lynn Alden provided valuable insights on gold and Bitcoin. She emphasized the need for central banks to diversify beyond the US dollar, highlighting gold's role as a resilient reserve asset. Alden also shared her bullish outlook on energy, particularly in relation to gold mining. Shifting to Bitcoin, Alden discussed the key factors driving its major bull runs, halving events and positive liquidity conditions. She stressed the importance of both factors aligning for optimal market conditions and offered practical advice on risk management for Bitcoin investors. Whether you're interested in precious metals or cryptocurrencies, Alden's insights offer a comprehensive perspective. Don't forget to like, subscribe, and hit the notification bell for more expert discussions. Thank you for joining us, and stay tuned for our next informative video.